Hello friends. Last week in this video, I told you that the bulls were gaining ground and they did. The markets closed higher. Will the bulls be able to continue to run up the performance that you saw last week? We are going to do a health check on the markets using our in-house exclusive indicators and do exactly just that. We're going to see whether the bulls have the willpower and the firepower to take the markets higher. I'm Vijay Bambwani. I design statistical trading systems in-house and I'm a prop trader since 36 years. Welcome to this video and we jump right in wherein you see a market roundup on your screen right now where the Nifty rose 0.64% and the Bank Nifty outperformed it by rallying 1.62%. So the banking stocks were back in the limelight. Not a very difficult reason to find because the RBI did not raise interest rates. The safe haven buying in gold and silver continued in spite of a rising dollar, which happens to be a small red flag for emerging markets, including India, because a rising dollar increases imported inflation in emerging markets. And the rupee also surrendered 0.10% versus the dollar, even though the Dixie rose 1.29. To that extent, the rupee remains a relative outperformer of its global currency peers. 10-year benchmark bond yields, and that worries me, rose to 7.02%. It crossed the threshold of 7%, as I had discussed in my recent video, that bond yields were likely to cross a round number. And there you are, they did that, which is a small red flag for banking stocks. Oil prices continued their decline by falling 2.30%, which is again a very positive indicator. It reduces the threat of inflation. Gas, on the other hand, jumped up to a little under 10%, which remains a minor concern. The NSE market cap continued to rise and it rose 2.33% last week, which is again a good sign. The market-wide position limits jumped to 25.53%, which is a good indicator because the two Marshmallow traders have basically ramped up their exposure. The Marshmallow theory is explained in this video. The hyperlink to the theory is in the pinned comment and in the description below this video itself. Overseas Qs were not too bad. The Dow Jones fell a little over 0.25%, but the Nasdaq fell 3.5% and the S&P 500 fell 1.25%. So tech stocks might be relative underperformers to a small degree. Looking at the MWPL chart on a daily period basis, we are seeing that in the second week of the derivative cycle, the MWPL has been rising at a steady clip, and whether this month we are going to see a crossover of the 30% MWPL is something that excites me. And do remember that this week is a truncated one because Thursday is a holiday on account of Ambedkar Jayanti and Mahavir Jayanti, and Friday, of course, is Good Friday. So it's a very short week, 3 trading sessions, where Wednesday will also be the weekly index options expiry, and it will act like a Friday, even though more exaggerated because they're going to be suspense of 2 trading sessions which are not available to us, and of course Saturday and Sunday being a weekend holiday. Now for the weekly MWPL chart, you're seeing that week on week MWPL has risen to the extent of what it did 3 months ago. And that's something which I told you is exciting me, from 20.87% to 25.53%. That's great. The two Marshmallow traders are showing signs of enthusiasm, and that's something which is a positive indicator. Now looking at the stock and index futures turnover, what I am seeing is that stock futures turnover has risen very, very mildly on the daily chart, whereas the index futures turnover has actually fallen. That's made even clearer on the weekly chart, which you're seeing on your screen. 4.5 months of data, 20 weeks. You can see that futures, stock futures, the turnover has risen a bit, whereas index futures have turnover has fallen. That tells me that risk appetite increased last week. The reason being, indices barely managed to fluctuate by 1.5 to 2% intra-week, whereas stocks can fluctuate 3.5, sometimes even 4% intra-week. Traders were willing to trade stocks in spite of higher intraday volatility, which means the one Marshmallow guys were showing signs of optimism. Going to the Bank Nifty and Nifty 50 basis chart. Now, basis is nothing but the premium enjoyed by the futures over spot. Look at how the Bank Nifty basis has jumped. It's a parabolic rise, which is a short covering triggered. People were basically shorting the Bank Nifty because it was relatively underperforming the Nifty since many weeks. And they got complacent. They got carried away by the fact that you go long Nifty, short Bank Nifty. That would be a good hedge trade, and that unraveled. The Nifty futures premium also went to 94.40. Now, that's the highest in the 20-day period on your chart. This tells me that there was ample amount of short covering seen in the market. The weekly chart of your futures basis tells you how the Bank Nifty basis has jumped sharply on a week-on-week basis, and the Nifty basis has also jumped, of course, but the rise is in percentage terms not as noticeably sharp as the Bank Nifty. But risk appetite, like I said, from one Marshmallow traders has definitely expanded. Now looking at the advanced decline ratio. Barring Thursday, wherein the advanced decline ratio fell below 1, we saw the other days when advanced decline ratio was very clearly and undeniably above 1, which means the number of stocks gaining were overpowering the number of stocks falling by a good big margin. The fact that Friday's advanced decline ratio is 2.13 tells me that risk appetite was higher on Friday, and seen on a weekly chart, the advanced decline ratio has eased off. But then do remember that 5.01 is not a sustainable number where advanced decline is concerned, and a little bit of a cool off was definitely expected. That said, if you take the low at 0.26 and the high at 5.31, we are definitely off the plateaus or the lows where advanced decline ratio has stuck around for many, many weeks, which is by itself a small improvement. Now let's take a look at the daily impetus of the Nifty and the Bank Nifty. On a day-on-day basis, the Nifty and Bank Nifty impetus has fallen on Thursday and Friday. But if you see the weekly chart, both the indices have shown higher impetus, which means net week on week rally in both the indices has been on higher impetus, and there was conviction from the 1 and 2 Marshmallow traders both. So chances are, if follow-up buying comes in the coming 3 sessions, which is all that you have to trade in the coming week. I told you it's a short week, Thursday, Friday being holidays. If the impetus chart rises, the bulls have more than a fair chance of prevailing over the bears. Now let's see the LWTD indicator, a newly launched indicator. The hyperlink to this indicator is in the description below the video. It's in the pinned comment as well, and it will appear in the end screen. Note how the Nifty percentage gain or loss has jumped above 0 on Friday, and the LWTD, which was falling on Wednesday and Thursday, but remained above 0. Do remember, it remained above 0, which is why I posted on my social media account that at best it would be a drag, but not absolute weight. Weight is when the market is collapsing under its own weight. Drag is when higher levels might witness some profit taking. But on Friday, both the Nifty percentage gain or loss blue line has shot up and the LWTD has turned back from marginally higher than zero levels. So it tells me that barring unforeseen circumstances, barring any bad news that might suddenly creep up on us, the opening levels on Monday seem to be optimistic as of now. Let's take a weekly LWTD chart here. The LWTD seems to have eased up on a week-on-week basis very mildly, as has the Nifty percentage gain or loss. But both, in spite of tapering downwards, are still above zero, which means the ball still remains in the bull camp. It is with the bull court, and they can take pot shots at the market should follow-up buying coming. I think the bulls have a fair chance, or more than a fair chance, of dominating the sentiments in the short week ahead. Now for the four categories of traders in the markets out there, the FIIs, stock futures net long positions, have continued to ease on a day-on-day basis all through last week, whereas the Nifty, the index futures exposure is little changed over the previous week, but it's very clearly the stocks where they are unwinding their futures longs. Where DIIs are concerned, they've reduced their net short positions on individual stock futures, and their net shorts are now at 15,47,385. Where their index futures shorts are concerned, they have basically remained more or less constant with little change at 54,996 lots net short. So DIIs are basically showing little change on a week-on-week basis. Let's take a look at prop traders. What are these guys doing? They've actually raised their net long positions in individual stock futures. Maybe they reduced their individual net long positions in stock futures due to expiry in the week before last, but they seem to be ramping up their exposure now. Where their index shorts are concerned, they've reduced their net shorts to 2,593 lots, which is a very small amount of shorts to hold. Let's now see what the retail is doing. Retail guys have been doing most of the heavy lifting where long positions are concerned, and they have built up their individual stock futures longs on every single day of the week last week, whereas their index net long positions have also risen, but not much. They now stand at 6,284 lots. Retail clearly seems to think that bullishness is likely to persist, and if the retail continues to buy the way they have been doing since June, July 2021 till December 2021, then I think the bulls have more than a fighting chance to prevail over sentiments. Friends, the studies done, I now come to the bond market, a very crucial aspect of the market, which unfortunately I see a lot of people ignoring, especially bank Nifty traders. You cannot look at bond yields as a standalone indicator. It is definitely a bearer of sentiments and influencer of sentiments in all asset classes. The fact that we've crossed the Rubicon of 7.02%, which is a multi-quarter high, it tells me that inflation expectations have risen. Markets are expecting interest rates to rise at a future date along with a rise in inflation. And since bond prices have fallen, which is why yields are up, there's going to be a mark-to-market loss position on banks' portfolio of bonds. And should bond yields continue to rise and stay above the 7%, there is another problem that you will face. You know, bonds, sovereign bonds, this is a 10-year benchmark sovereign guaranteed bond whose yield I'm talking about. If this is yielding 7% and higher, Your bank fixed deposits are still giving you 5.5%. Ballpark. If you're a senior citizen, you might get half or 3/4% more depending on which bank you are talking about. But your guarantee by the Credit Guarantee and Insurance Deposit Guarantee Corporation is only to the extent of 5 lakh rupees per individual, whereas government sovereign guaranteed bonds are 100% guaranteed. So 100% guaranteed investments are giving you 7% plus. Banks are giving you 5.5% interest, which means that this is a clear disadvantage to banks unless they raise interest rates. And if banks start to raise interest rates, their cost of funds is likely to go up. And for NBFCs also, the cost of funds could go higher. So keep a sharp eye on bond yields every single day. If bond yields continue to remain above 7%, you could have a slight problem. Of course, with a slight lag, I'm not saying that you go out and short the market on Monday. Doesn't quite work that way, but this is definitely a factor that a smart thinking investor like you, since you're watching this video, you care about data, you care about logic. So this logic is not something you should ignore. Friends, I now come to the US dollar index, another critical area which is ignored by many traders here, and you can ignore the Dixie or the US dollar index only at your own peril, because a very strong dollar means all imported prices, especially fuels, are going to be higher, and that results in imported inflation. So a strong dollar is always an anathema to import dependent economies like ours, and all our foreign loans in dollar denominated currencies are more expensive to service, which means pay interest for, and our principal payment is also impacted. So the US dollar index, as you can see on your screen, has risen on 4 out of 5 trading sessions, notching gains of 1.29% on a week-on-week basis. The only minor mercy that I see is an inverted hammer at the peak on the last day, which is Friday. You can see a small inverted red hammer there, which tells me that there was a little bit of resistance on the upside from the bears who tried to curb the rally of the US dollar index into the triple digit mark. That said, the dollar is now at its highest after May 2020, the dollar index. And a 23-month high does not bode well for emerging economies. The price has remained above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook remains positive. The trend line that I have drawn from June 2021, the dashed trend line, is providing excellent support on declines, and it's now 9 months, 10th month running in duration, which is a very, very dependable trend line. Unless the price falls below this trend line, I would say that the bulls remain in control of the US dollar index. Going now to the weekly chart, what I am seeing is a very big, powerful power candle, something that has overshadowed the body of its previous bearish red candle. And the fact that the US dollar index has pierced the 100 mark tells me that the rally is not to be written off so easily. And the trend line, which I talked about on the daily chart, is also drawn here on the weekly chart. It coincides with the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So even the medium-term outlook is positive. Now, last week, I advocated a range between 99.90 and 97.25. Well, that got exceeded by 30 basis points because the high was 100.20. So next week, I expect a range between 101.15 on the upside and 98.5 on the downside. Friends, I remind you again, do not take your eyes off the dollar index. Everything from our bond yields to currency markets, to gold and silver prices, and inflation depends on this metric. So be a well-rounded 360-degree worldview trader and take care of all variables that will impact any trade that you might have open. Friends, the dollar index done. I now come to the bank Nifty, which was clearly the star performer last week because it gained 1.62% and outperformed the Nifty 50 in percentage terms. As you can see on the chart, it's risen on only 2 trading sessions out of 5. But what saved the day was that it opened on Monday with a big gap up. So even though it rose on 2 trading sessions out of 5 only, but the gap up and the big power candle on Monday itself, the first big green candle, saved the day. And what you are seeing is that the price is above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the short-term outlook remains positive, and that average itself has now unmistakably turned higher, which means the average holding on cost itself is rising higher. Momentum is building up. Do remember a couple of weeks ago, I talked to you about the bump and run reversal, BARR, the two slanted trend lines, which I have drawn on the daily chart on your screen. The lower trend line has provided a rough and ready resistance to the price where it has retraced from. Once this price level of the trend line is overcome, which should be anywhere between 38,850 to 39,000 round figure. I would actually want a round number of 39,000 to be exceeded, and you will basically see short covering itself take the markets higher from there. Let's take a look at the weekly chart. You can very clearly see the bump and run reversal trend lines, which are oblique trend lines slanting upwards, which is where the Bank Nifty has encountered resistance on the weekly chart. What you are seeing is a very tiny body of the candle, whereas the upper shadow or the wick is clearly very large. So it is almost an inverted hammer. There was some amount of resistance at higher levels, but do remember that last week was critical because the RBI Monetary Policy Committee, or the MPC, was to determine interest rates, and traders were nervous ahead of it. Therefore, they were not buying the Bank Nifty as aggressively as we would have wanted them to. And do remember, my friends, bond yields are now at 7.02%, which means bond prices are lower and there's a mark-to-market loss on the bank's bond HTM portfolio, or hold till maturity portfolio. That said, the price is above its 25-week exponential moving average, which is turning up slightly, mildly, which means the 6-month holding on cost of an average bull is turning a little higher and the price is still above that. So the medium-term outlook also remains positive for now. In the week before last, this index was at number 5 on the most volatile counters list on the NSE, and it rose 3 notches and closed the week at number 2 on the most volatile list. Now, this is not something that's very good news for a rank and file retail individual trader, because statistical beta, or pure price volatility, is extremely high on the Bank Nifty and select banking sector stocks. If you can handle it, it will give you above average returns. If you can't handle the statistical beta very well, I think it's an anathema, it's a disadvantage or a challenge to an average retail trader. So you need to be extremely careful. Hold your trades with strict adherence to stop losses. Last week, I advocated a range between 39,100 on the upside and 35,225 on the downside, which held perfectly well. Now, somebody asked me, Vijay, why are you recommending such wide ranges? Am I trying to cover my ass by giving a range that's so wide that it can never be tested? I don't think so. Just see the intra-week high at 38,785 levels, 765 levels, and the high that I mentioned, 39,100. All right. You're basically seeing a very small margin, a cushion between what I said the Nifty can go up to and where it actually went. So I'm not trying to protect my backside. I'm basing this range based on our in-house statistical trading model, the IBEX, and it tells me that volatility, do remember, it's jumped up to number 2 on the most volatile list, which is why the ranges are likely to remain wide. In the coming week, you're likely to see a range between 39,675 on the upside and 35,825 on the downside. Friends, the Bank Nifty done. I now go to the Nifty 50, which managed to close the week with gains of 0.64%. And it is in no small measure due to the huge basis or the premium of the future enjoyed over spot, a little under $100. That's what made the Nifty go up and lodge week on week gains. Like the Bank Nifty itself, the Nifty also, as you can see on your chart, rose only on 2 out of 5 trading sessions. But Monday's open was with a big gap up, and it was a big power bull candle. As you can see, the chart, the candle itself was very large. The subsequent trading sessions on Tuesday, Wednesday, and Thursday saw that gap being closed, but net Friday's gain resulted in a net week on week positive closing. Now, the basis is something that I don't expect to hold forever. 94-95 rupee basis is not sustainable, so you need to keep an eye on that. And do remember that the week is short by 2 trading sessions. So if the basis comes down and the spot doesn't change much, you might actually see the Nifty suffer a little bit of a relative loss. But in the week before last, this index was number 12 on the most volatile list, and it rose only 2 notches to number 10, which means the volatility on the Nifty 50 is not half as much as the Bank Nifty. Therefore, if I was to bet on stability, I think the Nifty will be relatively more stable than the Bank Nifty. And what's really propping the market, the Indian markets, higher than its global peers is the fact that we have an LIC IPO in the pipeline, because of which Big Brother would be interested in keeping the markets buoyant or optimistic, which is one big factor in our markets going up, even if the global markets do not go up in similar percentage terms, or even if the global market is negative, our markets might relatively outperform because of LIC's public issue. Now, on the daily chart, you can see that the 25-day exponential moving average is turning upwards, and the price is very clearly and comfortably above this average for a fortnight or more, which means the short-term outlook is positive for now. And going to the weekly chart, I'm seeing a similar small-bodied candle with a big upper and lower shadow or a wick. That tells me that there was a tug of war between bulls and bears, but the closing was fairly close to the opening of the week with a lot of thrashing about intra-week. Now, we need a lot of follow-up buying to come in above the 18,250, 18,300 odd levels to take the markets higher, or possibly even into a new high. What you are seeing is that the price is comfortably above its 25-week exponential moving average, which is a 6-month-long holding on cost of a bull. So the medium-term outlook is also turning positive. Can the Nifty lodge a new life high? Chances are open. And as I told you, statistical data is indicating that the bulls have more than a fair chance of prevailing over the bears. So keep your options open and try to basically avoid short selling unless the indicator that I told you via a free broadcast on WhatsApp. My WhatsApp number comes on your screen right now. If you wish to be added to a free broadcast list, do send me a message on this number along with your full name and email ID, and we'll get you going for free immediately. So what you are seeing on your screen is that the moving average is turning higher, and once 18,250 or 18,300 has been overcome forcefully with 1 and 2 Marshmallow traders showing signs of aggression by way of advanced decline ratio being positive, the basis being positive, the turnover figure being positive, and the MWPL rising aggressively, then I would bet that the Nifty 50 would be preparing itself for a new trading high. And unless the indicator that I showed you on 15th of February via WhatsApp, the 25-week average trading system method, unless that triggers a sell, do not try to short sell the Nifty 50. If you are joining me late, if you've joined me after 15th of February, do send me a WhatsApp message. I'll repeat that message for you so you can understand that signal. You can use any free charting site like TradingView, investing.com, chartview.com, or whatever it is, and turn that into a very potential and powerful weapon to trade intraday basis, and highly profitably at that. It doesn't cost you anything at all, these free sites. Friends, last week, the range that I advocated between 18,350 to 17,000 again held wonderfully in spite of all the gaps, in spite of all the volatility and thrashing about, in spite of the fact that the Nifty went from number 12 to number 10 on the most volatile list. This range is holding thanks to the IBEX. In the coming week, I expect a range between 18,425 on the upside and 17,125 on the downside. I repeat, 18,425 on the upside and 17,125 on the downside. It might appear very wide to you, but do remember statistical beta is high. Trading sessions are numbering only 3 days, and therefore volatility can actually be significant. Do trade light and maintain stop losses extremely diligently. Friends, the indices section done. I now come to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high impetus. You take a small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus. You take large exposure, wait for small price moves, or scalp as it is known. Why the difference? Because there are different types of traders with different mindsets, risk appetites, and attitudes and aptitudes. So, hey, I'm giving you tools and means and methods to trade irrespective of what kind of a trader you really are. So, the high beta, high impetus stock list is led by Tata Power at number 1, number 2 Polycab, number 3 Idea, number 4 Havells, number 5 Torrent Power. Do note how many of these stocks have direct or indirect connection with the power sector, which is a buzzing sector in the last 1 week or more. The low beta, low impetus stock list is led by Indigo at number 1, number 2 PVR, number 3 Z, number 4 Titan, number 5 Cummins India. Friends, this hierarchy of stocks changes from day to day, and volatility of a stock can rise or compress every hour. So I would suggest you stay in touch with me on social media. My contact coordinates come at the fag end of this video. I update all this data on a dynamic basis every day on my social media accounts. Do feel free to connect with me. We can get conversations going, help each other become better traders, and you can update yourself in real time. Before I draw this video to a close, friends, I request you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Good, bad, or ugly, your feedback via the comment section is always welcome. Help me to reach out to fellow like-minded investors and traders like yourself who care about data, who care about rationality, who care about logic and a trading game plan by referring my video to your family and friends. Thank you for your patience, my friends. Till we meet again in my next, this is Vijay Bambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.